Ladies and gentlemen, the U.S. Treasury market 10-year bond is at all-time 2-year highs. Well, not quite 2-year highs, but you wouldn't know that from the financial media. It sure sounds like all-time. Well, and certainly it means something big. Something big is afoot. And that's maybe why the Federal Reserve is hiking, will be hiking, and tapering as fast as possible. Does it mean inflation? Does it mean anything? What does a 2-year high really mean, at least in the context of 2022? Jeff Snyder's going to answer those questions for us in 2 articles. He's the head of global research for Alhambra Investments. And at Alhambra Investments is where you'll find our very first article. It was posted on the 10th of January. It's not perfume, but it does smell funny. Conundrum number 5. Let us start with the relevant background. Yeah,
let's
tell
start
us.
with that, right?
I thought there
Bond
was only
yields
one.
have exploded. Bond yields are in the stratosphere. They're the highest they've been in almost 2 years, which is supposed to be some meaningful surpassing some insurmountable obstacle, as if a 2-year high is some big thing, especially since rates have been suppressed very low for those entire 2 years.
Yeah.
Somehow this is a meaningful shift, supposedly.
Which 2 years, business media? The 2 years that include a historic, mind-bending shutdown of the global economy? Is it that 2 years? Wow. We're at 2-year highs.
Be careful there, Emil. I think you're insinuating that the media is being hyperbolic for for disingenuous reasons. No, look, I mean, we're human nature, right? Human nature plus this silly business of finance where we have all sorts of charts and things and lines and trends and all these other things. We're told that this is supposed to be meaningful. The 10-year treasury yield hit 176, which was higher than the high that it had been last March. Therefore, it's the highest it's been in 2 years. So how could this not be some earth-shattering development, especially since bond yields at the long end, which have been a thorn in the media side, been a thorn in Jay Powell's side for all these years, suddenly they're starting to explode upward. At least that's how it's characterized. Whereas more sane and cool heads would look at the charts and say, yes, technically speaking, the 10 years at almost a 2-year high. Yes, technically speaking, yields have gone up about 30, 35, 40 basis points, depending on part of the curve over the last couple months, last 6 weeks or so. Those things are true, but how are they anything more than a market fluctuation? We've seen much bigger moves in shorter spaces of time that didn't amount to anything, as well as what we're going to talk about here. We've seen these multi-year highs numerous times before, and they don't add up to diddly squat.
In this era, in another era, they might have. It depends. That's why you guys are listening to this show. You're learning about what the monetary background is. Okay, let's talk about 2005, when it was a multi-year high. It was the highest in 4 years, I believe, that the yields got up to. And Mr. Alan Greenspan was in front of Congress in February of 2005, and he used a very famous word. It wasn't irrational exuberance. It wasn't proliferation of financial products. It was conundrum. What was the conundrum? What was he conundrumed by?
Well, the Federal Reserve had, after the dot-com recession, continued to cut rates because the economic recovery didn't seem to respond in the immediate aftermath of what was really a mild recession. But by 2004, the economy started to pick up. We started to see signs of life throughout the U.S. and much of the rest of the world too. So June of 2004, the Fed said, hey, maybe we did too much here. Maybe we kept rates too low, and there's risk of inflation. The FOMC meeting June 2004, from there on out, every meeting they had rate hike, 25 basis point, 25 basis point, 25 basis point. Almost a year into it, or 7 months into those rate hikes, dear Alan was sitting in front of Congress wondering why, hey, we're hiking rates. Why aren't long-term bond yields responding to these rate hikes? In fact, from June 2004 until February 2005, rates were actually lower at the long end. And Alan he told Congress, like, I'm totally confounded by this. He insinuated that we had never seen something like this before, which was a lie, but he was making it seem like this was some brand new phenomenon that the Fed couldn't explain because it had just showed up out of nowhere. So this was Alan Greenspan's conundrum, and he made Congress believe it was the first time that he or anyone at the Fed had experienced such a thing, when in fact that just wasn't true.
As you were talking, we showed that graph that showed exactly what we were describing, where you've got the federal funds rate being raised, and then you've got the short-term rates reacting to it. Great, great. But the long-term rate completely ignored it. And this didn't comport with how Alan Greenspan saw bond markets, or at least explained to Congress how they should be seen. Jeff, this is a quote that you often use right before you roll your eyes to the back of your head.
It's that ridiculous. It's one of those most, you have to cringe or roll your eyes whenever you hear this because it's so absurd.
Let's take the opportunity. This is a Eurodollar University classic. Let's take the opportunity to explain why you nearly pass out every time you hear this. Quote, Alan Greenspan, the 10-year long-term bond yields, quote, can be thought of as an average of 10 consecutive one-year forward rates.
Yeah, which basically means that the entire U.S. Treasury yield curve is under the control of the Federal Reserve because in his formulation, they move the front one. That's the one that they directly influence the most through the federal funds target or open market operations, whatever it happens to be. And then what he's saying is as a series of 10 one-year forwards, they all just fall in line. So if Alan is raising the federal funds target and threatening open market operations to achieve it, then all the rest of the curve should move in exact tandem to his rate hike. So if they had done essentially, 4 rate hikes, let's say, by the time between he started and they got to February 2005, that's approximately about that number, then we would expect yields to be higher, 1% at the front end because there's 4 25 basis point rate hikes, and then at least that much everywhere else down the curve. It should obey a series of 10 one-year forward rates. If anybody knows even a little bit about how the bond market works, this is just such a ridiculous proposition. That's not how it works. And we even talked about this just recently. Yes, the Fed can influence the front end of the curve. As you pointed out, Emil, on that chart, you see short-term rates out to about the 5-year Treasury sort of obeying Alan's command. They're moving up in tandem with the federal funds rate. But then you get to the middle of the curve and further out, it acts completely independently based on Irving Fisher's formulation from over a century ago, growth and inflation perception. So the Fed is pushing the front end up and the long end is saying, I don't agree with why you're pushing rates up, Alan. You think that inflation's a risk. We don't see it at all. So that was really his conundrum, which was, we see inflation. We're the gods of all finance. We're the lords of all economy. We're raising rates. Then everybody should just simply fall in line and obey with what we say. And it's a conundrum, a brand new conundrum when this doesn't happen.
The chutzpah. It's funny, yeah, because I'm glad you mentioned that it was Irving Fisher's 100 years ago now, but 80 years ago then, right?
So and it wasn't exactly controversial. I mean, everybody pretty much accepts that's what long-term yields are, that Irving Fisher was right back in the early 1900s, that it's growth and inflation expectation.
Now that conundrum is very famous if people don't have lives and they follow this sort of work that we talk about. Okay, so it's famous in that sense. The other conundrums are not as famous. Now I'm going to segue. And you're going to tell us that there were previous conundrums. Okay, quote, here he is, Mr. Greenspan again. For the moment, the broadly unanticipated behavior of world bond markets remains a conundrum. Bond price movements may be a short-term aberration, but it will be some time before we are able to better judge the forces underlying recent experiences. And then you tell us, this may be very surprising to people, that he was being deceptive on purpose. What was he being deceptive about?
That there was actually something similar taking place twice beforehand. And the episode just prior to that was only a couple years beforehand. We're talking about the late 1990s and early 2000s leading up to the dot-com recession, as well as the Asian financial crisis before then. And the same kind of thing. It wasn't as extreme as it was in 2005, but 1999 into 2000, you had a similar setup where the Federal Reserve, fearing an outbreak of inflation, decided to raise interest rates. And by and large, the short end of the yield curve obeyed those interest rate increases as it would continuously. The long end was a little bit skeptical. The yield curve flattened until we get to early 2000 when the market started to really resist. And even though the Fed would continue on with hiking rates, in fact, do a 50 basis point rate hike in the middle of 2000, which was the long end of the bond market saying, look, we don't see this inflation risk. In fact, we see the opposite. So already in the year 2000, there was the second conundrum where the market was not obeying was not acting like a series of 1 year forwards just a couple years before Greenspan told Congress this was something new. And then we go back even earlier than that to 1997, 1998. There was only one rate hike in that sequence, but still, the idea in 1997, 96, 97 was that the Fed was going to be hiking rates again because it needed to cool off the economy. The long-term end of the yield curve said, no way. And so you had the same sort of conundrum, and maybe its most primitive and nascent form, which is still the same problem. This dichotomy where one part of the yield curve does one thing and another part of the yield curve sort of responds to the Fed, but only temporarily until it joins the long end of the yield curve in expressing skepticism. By the time Greenspan got to Congress in 2005, that wasn't the first time. It was actually the third time we'd seen this dynamic in the yield curve where short rates, for the time being, for a temporary period, will do what Greenspan wants them to do, but only up until about the 5-year Treasury note on the yield curve. From thereafter, all bets are off. If the long end of the curve doesn't see in growth and inflation and real plausible scenario for those things, and it doesn't matter what Greenspan says, and it doesn't matter what Greenspan does. It doesn't matter what Bernanke says or Bernanke does. Or bringing this up to the current age, it does not matter what Jay Powell says or what Jay Powell is about to do. If the long end doesn't see growth and inflation, conundrum.
It's interesting coincidence how the Asian financial crisis serves as a prototype for a couple of phenomena that we like to talk about. It was the prototype for the global dollar shortage, that time regional, and a prototype for the conundrum. The first one there, then the one in the dot-com bubble that we had yields rise to the highest in 2 years. Then in 2005, the most famous conundrum, where yields were the highest in 4 years. And now we're coming up to present day when the yields are highest in 2 years. But before we get to present day, let's talk about another conundrum, 1, 2, 3, number 4, the one that occurred in 2018. And we're going to do that one by going to another article, conflict of interest rates. The 10-year Treasury yield highest in almost 2 years. And Mr. Tateo, did I say that right? What a great, great phrase. Conflict of interest rates. Okay, Jeff, 2018, bond yields rise to 7-year high. Time to worry? CNN Business. CNBC, 10-year yield jumps to highest in 7 years as investors bet on roaring economy and higher inflation. Reuters, after market rout, signs point to even higher bond yields.
We laugh about it now because, within a couple weeks after those articles, those headlines were splashed all over the TVs and all over the internet, the entire bond market reversed, and we haven't been anywhere close to that since. So to our original point, a multi-year high, this was a 7-year high. This was the 10-year yield getting higher than it had been in 2013, the end of 2013. This was higher than the taper tantrum. Why wasn't it significant? Because it's not. It's just not a significant marker. It's something that we humans intuit and say, oh, this must be significant, but that doesn't actually mean anything. It actually meaningful is behind the move in interest rates. In fact, when we look at, as you just did, Emil, these patterns that repeat time and time again, 2018 was almost boring, because it was exactly the same process as the middle 2000s or 2000 and the conundrums earlier. So we see that the bond market at the long end of the yield curve is saying, no, Jay, no, Janet, we don't see the inflation and growth you're talking about. Yet the Fed does the rate hikes and pushes the short end up anyway. And eventually those two parts of the curve come into collision. They come into conflict of interest. So the long end resists, the short end gets pushed up by this non-economic policy decision. And that can have a temporary effect on nominal levels at the long end too, because the long end might be resisting that upward pressure from the short end, but it can get pushed up itself. And so in 2018, throughout much of 2018, long-term bond yields were rising. They were moving up. They weren't moving down. They were moving up, but they were resisting the short end movement, which is why the yield curve flattened, which meant they were not rising nearly as much as they were at the short end, which is the same thing as saying, we're skeptical about your position, Jay Powell. We don't believe in what's going on. And so the yield curve flattening rather than the rising level nominally is what should have grabbed everybody's attention. But that's hardly the sexy headline that highest in 7 years actually is.
That's the key, Jeff, right? Because we always say on this show, look to the bond market. So the audience, that's our repeat audience, whatever, however many tens of people that is, yes, they may be wondering what's going on. Have they drank perhaps addled eggnog that's still around from Christmas? Because they always tell us bond yields are important. The bond market is important. But there are multiple ways of looking at the bond market. And yes, the nominal headline yield is important, but also the curve that you just mentioned there at the end. And as we've been implicitly saying throughout this episode, is it's that curve, the spread is what we want to see rising in concert, the whole thing, not flattening out. And in 2018, what else did we see? We saw other measures in disagreement. The US dollar, the Eurodollar futures curve.
Same things that we're seeing today, right?
Yeah,
I mean,
exactly.
It's amazing how history repeats itself. But I think that's the point you really want to make here, Emil, is that when we're looking at the bond market, we say turn to the bond market for answers. The nominal level can tell you something, but that's not the only part of it. You need to look at the yield curve shape for confirmation, for context, for more depth to your analysis. And so if we see nominal yields rise, that might be the bond market saying growth and inflation expectations are increasing. That was certainly why yields were rising last year in the early part of 2021. That was what we would expect to see when things are getting better, because the bond yields rose more at the long end than at the short end. The yield curve steepened. So that time in that episode, that instance, nominal yields were rising, and it turned out to be a positive or more optimistic setting, because of how the overall curve shifted and the dynamic nature of what was going on then. This year, nominal yields are a touch higher than they were at that point last year, but the yield curve is in a very, very different place and a very different shape. That tells you that the reason why nominal yields have risen at the long end is very different this year than what it was last year. Last year was about, hey, we're improving. 2020 was a disaster. 2021 won't be as much of a disaster. And maybe the future won't be as bad as 2020, low bar, but still. 2022, long-term yields are being moved up in the same way they were being moved up in 2018, which was this transition to this non-economic policy interference at the short end. Not because of growth and inflation expectations, but because Jay Powell thinks he has to raise rates because of inflation, that the bond market just doesn't see at all, which is why we're seeing this conundrum number 5, at what is really an obscenely low level.
That's right. I don't have anything more, Jeff. You summarized it very well. The fifth time, and I guess we shouldn't sell the farm just yet, ladies and gentlemen. We should take a look around and look at the other monetary measures. This is the fifth time we've seen this since the late 1990s. Let's see before we believe that there's a rip-roaring inflation. Anything from you, Jeff?
Yeah, look, multi-year highs don't mean squat. They really don't. Without some major context to go along with it. So, we can look at the highest yield in almost 2 years and just completely ignore that. It's just noise.
I have a visceral example of multi-year highs and how it means nothing. President Trump, when he was in office, he would always talk about how high the stock market is and how low the unemployment rate is. And when President Biden was put into power, it was assumed that he would be much less crass and much less orange. Guess what? This last weekend, the White House put out a statement showing how many jobs gained under the Biden administration and compared it to all previous presidents. So the most jobs gained in the last year or two. Is Joe Biden the greatest president in American history along this one measure? Yes. Multi-year high. Wow. It was so crass. It was so orange. I thought we were beyond the orange stuff, Jeff. What am I trying to say? You know what I'm trying to say.
Things can be, if you take anything out of context, it can be
out of context.
Right. And even again,
Gross.
as we started out, yes, the 10 years at almost a 2-year high, though it's not today. Yeah, that's fine, but it's still 1.75. That's not a big number. So it's closer to a record low than it is the peak of the last cycle, which was 2018, when we had a 7-year high that lasted all of a couple weeks.
I feel like we're in 1939 and they said, look at this, guys. It's so much better than 1937, 1938. Great.
That's
Good.
true, but it doesn't mean anything to the regular person trying to live their life.
Speaking of depressions and difficult eras and difficult moments in history, in part 3 of this episode, we're going to talk about something that's very popular on social media recently. And it was made possible by an interview by Chris Martenson, and then even more popular by an interview with Joe Rogan. And it's this idea of, what is it called? A broad psychosis, deep psychosis. What is it, Jeff? What is it called?
Mass formation or mass formation psychosis, which it sounds very clinical and scientific and whatnot, but I think it's easily relatable and understandable.
And you know what was missing from both of those interviews is the reason why. So I believe they had identified, hey, we're seeing something strange. We're going to label it this. Makes sense. They couldn't quite put their finger on why, and that's what we're going to talk about in part 3.